Markets have been trading in and around record territory, and all that volatility we saw last month seems to be over for now, but investors should not, of course, get too complacent. I'm joined by Randy Frederick, Managing Director of Trading and Derivatives with the Schwab Center for Financial Research. Great to see you here, Randy.
Thanks for having me.
And you're obviously here at an interesting time because we've had fascinating market moves in the last couple of weeks. What did we learn from all that volatility we saw after the Brexit, and now here we are at record highs?
I think what we learned are some of the things we've learned many, many times in the past when a big unexpected event happens, and that is that if people are surprised, they'll overreact. And I think we knew the odds of the Brexit succeeding were much greater than zero, and yet virtually everyone expected it to fail. And as a result, we had a very sharp reaction in the market, but it was an irrational move. And it really only took a couple of days for people to realize that, oh, hey, wait a minute, this isn't something that's going to be over in a month. This is going to be a 2-year process. And as soon as people sort of got back their rational thoughts about themselves, they realized that, oh, hey, wait a minute, maybe this means lower rates in the U.S., which means that stocks should do well. Maybe this means people will put their investing capital into the United States, and that might make the bond market do well, and that's exactly what we've seen. So I will admit that it was probably a little quicker of a turnaround than I expected, and certainly a little bit sharper. But emotional reactions oftentimes mean opportunity for investors.
And you actually make a great point about a lesson learned here, and that is you should be hedging for event risk.
Right.
And is part of the problem that investors aren't sure how to do that, or they're not sure of the costs involved, or they're just complacent?
Well, I think it could be a number of those things. One of the things I think that people spend a lot of time on, and unfortunately a lot of money, is trying to hedge for unexpected events, things that completely come out of the blue. They happen so rarely. Talking about things like the 9/11 attacks or the 1987 crash or the flash crash. I mean, you can count the number of events like that on one hand that have happened over the last decade. And yet we know many of these what we call known unknowns. We know the exact day that the election is going to happen. We know when the Brexit referendum is going to happen. We know when the Fed meets. We know when the ECB meets. These are all dates that are on the calendar that don't change. And so it's actually quite easy to hedge what we call a known event or an event risk, and it's very simple. And in fact, this was one of the best examples. I put out quite a bit of commentary prior to that, kind of trying to remind people to do that. You can very easily hedge and very cheaply hedge by using something like an options collar, which is buying a protected put and paying for it by selling an out-of-the-money call. The only risk to that type of a strategy is simply if the market takes off very quickly and you miss out on some upside. But if you keep it relatively short term, you're only going to miss out on that opportunity for a day or two. Because the Brexit referendum happened on a Thursday, there were a lot of options that expired on the following day, on Friday, that you could have used as a hedge that frankly would have paid off very nicely. And not that you'd eliminate all of your downside risk, but you could have taken what ended up being a 5.5% downturn and maybe limited it to 1%.
Right,
or so.
and I think people prefer that than missing some of the upside, right? They'd rather not lose the money.
Right.
When you look at the markets for the rest of the summer or the next couple of weeks, a couple of thoughts on what sectors do you think look attractive? Going with the sense that maybe parts of the market might not stay at records, maybe parts are overvalued. When you break it sector to sector, what looks good right now?
So there are a lot of things that you can look at, but it all kind of depends on what your outlook is for certain things. So for example, we've seen inflation data start to pick up. We've seen wages start to rise a little bit. Both of those things tend to look relatively positive for the consumer discretionary sector. Right now, we have a market weight rating on consumer discretionary, but that could change to the upside if we continue to see wages go up and we continue to see inflation go up. People don't spend discretionary money on things that they don't need if they think the price is going to be the same in a month. But if they think the price is going up, then all of a sudden it creates a sense of urgency and they go out and spend that money. Likewise, if they see their wages going up, they end up with more discretionary money and it makes them that much more likely to go out and spend money as well. So that's something that could change. We've had an outperform rating on technology and financials for quite a while. We continue to keep those ratings on and we probably will. Financials in general have a lot of cash on their balance sheet, so there's a lot of opportunity there. We've seen a lot of M&A activity within the financials, and within the technology group with financials. Of course, if your outlook is that interest rates will go up, and there's now a fairly decent chance that we might see another interest rate hike by December, financials will tend to outperform when that happens. Now, if you think interest rates are going to stay the same, then maybe that doesn't happen, but ultimately it depends on what your outlook is on a few things like that.
And what about expectations for an underperformer?
Well, one sector that has been at a market weight for a while that could potentially struggle is something like healthcare. And part of the reason for that is if you listen to some of the political candidates right now, which side of the aisle you're on is almost irrelevant. They all seem to think that there needs to be changes to healthcare. There needs to be additional controls put on the pricing of things like drugs, right? Some of the companies, the insurance companies especially, that have benefited greatly from Obamacare are either requesting to get out of that or to raise their rates substantially. So those things are all going to create all kinds of turmoil and uncertainty in that group, so there could be a change based on that.
Randy Frederick, we'll end it there. Good to talk to you. Thanks so much.
You're very welcome.
I'm Rhonda Schaffler for The Street.